Welcome back to this month's edition of Common Sense, sponsored by Ohio Valley Bank, where we talk about current issues as they relate to the business world and the banking industry. Ryan, it's getting close to that time of the year again. I know it's your favorite time of the year.
It is.
Not only for hunting season, obviously that's one of your favorites, but also the big F.
Football.
That's right, football. So Buckeyes are positioned
actually,
well?
Yeah, they are, and this is being recorded. It's not live, so we would usually talk about the game a little bit, but it will usually probably be played after the game's played tomorrow night, so probably not a good idea.
There is a big primetime season opener tomorrow night on Thursday night.
Absolutely.
So,
what team?
Playing against the Indiana Hoosiers, so hopefully we'll have good news to report on that, plus another big game coming up against Oklahoma at our next month's show. So, all right, a great deal. Well, anyway, today we're joined by Shawn Siders, and Shawn is the Vice President and Senior Credit Officer for Ohio Valley Bank. And today we're going to talk a little bit about how to analyze your business for better credit performance. And so, good afternoon, Shawn. Welcome to the show.
Good afternoon.
All right, and why don't you start out by telling our viewers a little bit about yourself and what you do there with Ohio Valley Bank.
Sure. I graduated from Point Pleasant High School. About a month after I graduated, I started in the mailroom at the Ohio Valley Bank. I've been there about 16 years. I've worked in several different departments before eventually becoming the Senior Credit Officer of the bank. My primary responsibilities are monitoring, measuring, and managing the credit risk of the bank. I've managed the credit administration function, which reviews new customers as well as existing customers that meet a certain threshold. Also work with external auditors and examiners on credit-related issues. I'm the treasurer of the Gallipolis Rotary Club, but what I'd say my favorite job and responsibility would be that I'm father to two wonderful little girls. I told them I'd give them a shout out while I was here.
All right.
Savannah and Sydney, Daddy love you. Daddy loves you. So that's about it.
Okay. Great. Well, we really appreciate you joining us today and really sharing with the people in the community about what they're really up against with the business looking to get a loan. But anyway, you mentioned what you do. So today we're going to really break down all those different components that you look at whenever you're helping the bank determine whether to make a loan. Obviously, you're the expert, and today we're talking to a lot of folks out there that know a little bit about loans, but they don't know all those different aspects of getting a loan. And probably, I know a lot of folks we work with through the Small Business Development Center, whenever they have a lot of questions for us. Really, what am I up against wanting to get a loan? What things do I need to prepare for when I go to get a loan? How am I being judged? How does the bank really see me? So today, that's what we're going to talk about. So maybe we could start out with going over some of the basic information. Why don't you tell us a little bit about some of the most widely used financial reports that you guys look at and why each of those are important?
Okay. The three basic financial statements would be the balance sheet, the income statement, and the statement of cash flows. First, I'll start with the balance sheet. That lists all the assets, liabilities, and equity of a business. Typically, it's organized in order of liquidity, or how close something is to cash. So obviously cash is the closest thing to cash, so it would be number one. Then you would have like marketable securities. Those can readily be sold, so they're the next, and equipment, inventory, accounts receivable, those kinds of things, and then your fixed assets. Then on the liability side, it's pretty much the same thing. It's pretty much what you own and what you owe, and the difference of those two things being your equity or net worth. That's a big one. The income statement obviously is basically how well you've performed over a period of time, typically 1 year. You would have all your revenue and other sources of income, whether it would be from sales or any other type of income you would generate from other sources, and then you would have all your expense items. It's really important to organize your expenses, be pretty organized and diligent, so you could eventually, at the end of the day, be able to compare things, because ratio analysis is really the key to understanding how your business is performing, not only by itself, but comparing it to others in your peer group. Then you have the statement of cash flows, which basically looks at how those two statements work together and shows the end-of-day cash your business has to work with through operations, financing, investing, that kind of thing.
So maybe take just a minute and tell us the difference between the income statement and the cash flow statement.
The income statement, basically, like I was saying, shows how much you have sold, your expenses, and how much you've brought in. But depending on how those things flow to the balance sheet, that may not translate into how much cash you've held. So say you've sold $1 million in goods, okay, but those sales are sitting in accounts receivable. You haven't collected those yet. That would be taken into account in the statement of cash flows. While on your income statement, it shows that you've sold that and you've received, you've expensed that and all that, and you've made a certain amount of money. On the statement of cash flows, since you haven't actually collected that yet, it's still sitting in accounts receivable. It hasn't really affected your cash position quite yet. So
that's a good explanation, because I know when meeting with clients, we get that question a lot. Well, the income statement looks exactly like the cash flow statement in their mind, so that's a good example on how to explain that. You did mention ratio analysis. Can you talk a little bit more about that, and maybe how you can compare your business to other businesses or other peer businesses?
Sure. Ratio analysis to me is vitally important. That shows how well you're performing compared to someone else. For example, and I like to use an example. So say you have a small business, okay, and they have $100,000 in assets, and then they generate, let's say, $1,000 in income. So their return on assets would be about 1%. Then you take a company that's got $1 million, and they've generated $1,500 in income. On the surface, if you're just looking at raw numbers, the $1 million company has produced more income. But when you look at how efficiently they've utilized those assets to produce income, the smaller business was far better. Another example I'd like to use, and this gets into ratio analysis a little bit, is so say you have somebody who's digging a hole with a shovel, and then somebody who's digging a hole, with a bulldozer, okay? And in 1 hour, the person with the shovel digs a 10-foot hole. The person with the bulldozer digs an 11-foot hole. Well, on the surface, the 11-foot hole is deeper, but you would think they would have been much more efficient given the amount of assets they had to use. So the person digging the hole with the shovel was able to produce more with less.
Right. Yeah, that's a good explanation. And I know we teach a small business class in partnership with Pike County Community Action. I teach the financial part, and what you said about the efficiency as far as 100,000 in sales versus 1,000 in income and $1 million in sales. I've used that same exact example. So to get some of the numbers, when you try to make the peer comparisons, a lot of the numbers aren't available publicly. How can you gain some of that information and be able to and know that it's accurate, I guess?
It basically depends on what kind of industry you're in. There's certain types of reports for certain types of industries. For example, hotels and motels utilize what are called STAR reports, which show industry-specific data. Your average daily rates and things like that. Other industries use different types of information from other resources. My recommendation would just be to do a quick Google search and search for industry information about your particular industry, and there are oodles and oodles of sources out there. Some will be free, some you may have to pay for, but it's out there.
So if you just do a Google search, that information you think is reliable enough, accurate enough that you could use that for example, I'm currently working with a client that's wanting to invest in a truck stop and or a travel plaza. So I'm kind of stumped in where to gain some information. Are there any? Could you give me any pointers for that?
One company we've utilized for industry analysis is IBIS World, I believe.
Mm-hmm. Yep.
And they have a bunch of industry specifics.
Okay.
I mean everything you can ask for.
Yeah,
sure.
I mean A to Z.
Okay.
And one thing you want to really focus on when you're looking at industry information is how many sources are reporting to those people. Because if there's only 3 businesses that have submitted information to that company, that you're going to have all sorts of variations with such a small sample.
Yep.
If you got somebody that is reporting 10,000 different business information and similar asset size and those kinds of things, that information will be a lot more reliable.
Okay. And then once you do the ratio analysis and you can start comparing that to other companies and with the bank. I know you don't share information between companies, but you have all that information available. So maybe talk a little bit about a SWOT analysis. I would say that's probably the next step in analyzing credit.
Your strengths, weaknesses, opportunities, and threats. Ratio analysis helps you a lot in this aspect. I mean, whenever you're comparing yourself to peers or whatever, you'll see what your strengths are. You'll see how well you're utilizing your balance sheet to produce income. And you'll see kind of where your strengths and weaknesses are from that standpoint. Now, looking at opportunities, one thing I would say is, always look at your market and try and find if there's a need for whatever product you're wanting to produce. Say you're a new startup and you're wanting to start a business. Make sure there's a need for that product, or you can generate demand for that product, and there's enough population to support your business, given what your fixed costs are and all those kinds of things.
Right. Yep.
Now, from the threat standpoint, one example I like to use is try and focus on not only what you aren't doing well, but what where your competition is coming from. And sometimes it's not always what you would expect. And the example I like to use is, everyone's heard of, Blockbuster. At one time, they were the biggest player in renting, movies and games and all that kind of thing. Nobody could touch them, and they ran the industry.
Right.
Well, they weren't looking out for substitutions. I mean, there are other ways of getting digital media and those kinds of things, and that was a shift in technology.
Yep.
And a lot of times your threats can come from that avenue, I guess.
External threats.
External threats, yes.
Absolutely. Absolutely. Well, anyway, it's time to take a quick station break here. And we'll be back in just a few minutes here with with Shawn Siders, the credit analyst for Ohio Valley Bank.
You want to link back off?
Yeah, it's right there. All right, welcome back to Common Sense, sponsored by Ohio Valley Bank. And today here with Shawn Siders of OVB, and we're going to continue to talk a little bit about analyzing your business for some different credit aspect ratios. Shawn, we did have a quick question that came in from one of our viewers about protection to you personally as it relates to your business loans and business operations. And if we own a business and we take that business and incorporate that business, does that protect us as a business owner from losing our personal assets such as our home?
That's a good question. I'll answer it in 2 ways. One, from the bank's standpoint, whenever you go to borrow money, typically, especially if you're a new startup, they'll require what's called a personal guarantee. So they'll get the guarantee of your business and also you personally, and that protects the bank. If the business fails, they can, obviously try and obtain some of the assets that you have personally. Now, you can structure your business within like a limited liability company or something to that effect. I'm not an attorney, so I can't really speak
Right.
too much to all the legalities of it, but there are ways you can incorporate and kind of protect yourself from personal liability that way. But
Okay. And another quick question. I know we all as individuals have credit scores. Does a business have a credit score?
That's an interesting question. I'll answer it in this way. I guess the best way that we would equate a credit score for a business would be looking at kind of the depth of management, how they've paid their bills in the past, you know, what their background is in that industry, and those kinds of things. I mean, there's not a quantifiable score.
There's not really, but it's all these things put together that we're talking
Yeah.
about today.
And it'll be a subjective measurement based on all those factors.
Okay.
And primarily talking about credit score, credit, commercial, when you're analyzing a commercial credit, a lot of times the personal credit is justification to the bank to make the loan or not make the loan. Because I've had, well, I'm a recovering lender myself. I've spent about 8 years with Oak Hill banks, but so we did some commercial and some consumer credit and the difference. But a lot of times I think, you know, when people start a business and they incorporate or they form a separate entity, they think that takes them completely out of the credit picture. That's not the case.
Correct.
So maybe talk a little bit about credit, personal credit, just what's good scores, what's acceptable for the bank.
As far as credit scores go, of course they range, and I think the range is from like 450 to 850 or something like that. I think in the industry they call subprime less than 650. So anything from 650 to 700, I would say is adequate. You know, average. Anything over 700 is pretty good.
Sure.
Or A tier. Different banks have different ranges for what they consider, you know, a prime credit.
Yep. Okay. So I guess we jumped ahead just a little bit. I had a note here. We wanted to talk about the 5 C's of lending, and I got to one of them early. But can you tell us what the 5 C's are, and maybe talk a little bit about each one?
Sure. The first one that we've already mentioned, of course, is character. Typically, character is on the retail side, determined by your credit score, and then on the commercial side by the depth of management and those factors. The other 4 C's, capacity, which would be basically your ability to repay the loan. On the retail side, that would be determined by your debt-to-income ratio. On the commercial side for businesses, that would be typically determined by your debt service coverage. So how much cash flow is your business producing in relation to the obligations of your debt.
And to talk just a second about the debt service coverage ratio or debt to income ratio, what are acceptable ratios? And I know that can depend varying on the business and the amount of sales and all that too. But I know when I was in lending, lots of times, you know, a debt service coverage ratio of 1.2 and above was acceptable. Obviously, the higher the better. But
right. On the retail side, typically anything under 40% is acceptable. You would typically be approved for a loan. Of course, it depends on other factors. So the lower that number gets, the better. Like you said, on the commercial side, for businesses, debt service coverage of about 1.2 or better. All different banks have different thresholds for that. I think, you know, 1.25, 1.3 is pretty normal. It depends on the industry. Certain industries have lower, and then also, you know, if you have a nonprofit, they're not expected typically to have as high of a debt service coverage. The stuff that they're bringing in, they're giving out. So anything 1 or just north of 1 would be acceptable.
Well, and I think, yeah, if you go back to the example you gave earlier, if you have a business that has $1 million in sales and 1,500 in income, and versus 10,000 in sales and 1,500 in income. You can look at that as somewhat in that light that there is a ratio there. So if you've got a lot more in sales and less in income, you're going to be looking at the debt service coverage ratio kind of the same way, meaning that if you have 10,000 in sales and only 1,000 in income, that means you only have $9,000 left over for all your expenses. Where if you have $1 million in sales versus $1,500, then you've got 900 and do the math available for expense coverage. So, yep.
Well, these are all very important things that, I know when we work with people with the Small Business Development Center, these, 5 C's of lending are all things that we want our clients to demonstrate in their business plan, to put in there all of your history, all of your capacity, all of your character, just everything. That's all a part of the whole package of, getting a loan for your business and being successful. So.
Yeah, and you might mention collateral as
Sure.
one of the 5 C's. We haven't really talked about that yet.
Sure. One of the other C's, collateral. I mean, that basically is protection, for the bank. So if you're not able to repay the loan, obviously, the collateral is our secondary source of repayment. So we'll look at that, and depending on the type of collateral, we have different ratios. So, for residential real estate, typically 80% is what we'll loan on that. So if you have a $100,000 house, we'll loan 80%. I mean, there are different programs. Ohio Valley Bank has different programs that will go higher than 80% under certain circumstances. But then there are other types of collateral, and they may be willing to go higher, and some that will go lower. It pays, normally depending on the marketability of the collateral, how easy it is to sell and how much of a discount they may have to take.
Perishability.
Yeah,
A grocery
exactly.
store, for example, the majority of their inventory is perishable, so banks aren't interested in
loaning 80% on milk and bread.
Yeah,
Exactly. Well, and that's, we work with a lot of small businesses and folks who already have some assets that are looking to get a loan to grow the business. They say, well, I have a pickup truck, I have 2 lawnmowers, I have a trailer, and they put a value, like the pickup truck may be worth $10,000, the mowers and the trailer may be worth another $10,000, market value. But really, so that's maybe totaled up to $20,000, but really, when a person comes to the bank and they say, we have these assets, the bank really doesn't say, well, you have $20,000 in assets. And some of those, let's talk maybe just real quickly about equipment and how that what the bank looks at as far as equipment, especially equipment that's been in use and used.
So equipment's a good example. Yeah. So we won't loan. We typically will look at about 75% loan to value there. Whenever somebody buys, equipment and they're using it, that depreciates much faster than real estate does.
Right.
So in the event, the borrower or the bank needs to liquidate the collateral to pay the loan, they're probably not going to get, they're probably going to get a much bigger haircut on whenever they go to sell that than if they did probably a piece of real estate. So typically, go ahead.
Oh, and I was just going to add too, the collateral can also determine the length of the loan that you're eligible for.
Yeah.
For example, real estate, you could stretch that out over 20 years. Equipment, we're not going to stretch it out over 20 years for one, and it's worthless after a certain. Most of it would be worthless lose its worth after a certain point, but typically 5 years on equipment.
5 to 7 years.
5 to 7.
It just depends on the type of equipment.
Sure.
Everything depends, I guess.
Right.
Certain equipment depreciates much faster than others. If you've got a bulldozer, maybe 7 years. If you've got computers and things like that, maybe 3 years.
Right.
Yeah.
Okay. Well, we've got just about a minute left, but just one quick last question. Something specific to Ohio Valley Bank. What are you seeing a lot of loan requests come in for now in the area? What's popular? Is there an industry segment that you see that's really growing in this area?
the majority of the loan requests that me and my area see are for residential and commercial real estate. We have a lot of investors that are buying residential real estate to either rent or refurbish and sell, and then same with commercial real estate. They either get a loan to build the building, they have somebody in mind, they have a lease in place for somebody to occupy that property, or it's speculative, you know what I mean? So
Okay.
I'd say commercial and residential real estate's probably our biggest.
Okay.
Good.
Well, that's a good thing, though. But
Yeah.
but the area is, we've got stuff in the works. Stuff's moving, and that's a good sign for our local community.
That's good.
So anyway, well,
Well, Shawn, a lot of good
yeah,
information.
Absolutely.
We appreciate it.
Thanks for having me.
And,
We're running short on time. It's something we could probably talk another half hour on if we.
Oh, I'm sure.
So maybe we'll do a part 2.
Okay.
All right. Well, for Brad Bapst and
I'm
Ryan
Ryan Mapes.
thank you for joining us with Common Sense.